Look closely at the safe part of your life. Your pension. Your insurance policy. The boring savings product you barely think about. Behind the scenes, a huge chunk of that money is parked in one place: government debt. And here's what makes the modern world feel like a riddle. Every country is in debt. The US has crossed $38 trillion in federal debt. Japan's government debt is among the biggest on earth in scale and in debt to GDP terms. And global debt? A recent IIF estimate put it over $324 trillion by early 2025. Europe's government debt ratio remains elevated too. So the obvious question is: if everyone owes, who is the world paying? Tonight, we're going to answer that, but not with slogans. We'll follow the paper trail where it actually goes: into your retirement accounts, into bank balance sheets, into central bank portfolios, and into the collateral that holds global finance together. This is Empire of Money, where power leaves fingerprints in the numbers. The first twist: debt is someone else's asset. To solve the paradox, you need one mental flip. A debt isn't just a burden. It's also a product someone owns. If a government issues a bond, the government records a liability. But the buyer records an asset. That means, who is owed, isn't one villain sitting on a throne. It's a long list of holders. Pension funds. Insurance companies. Banks. Mutual funds. Households. And, quietly, massively, central banks. So when people say, countries owe money to other countries, that's only a slice of the picture. Most of the time, countries owe money to institutions and citizens, often inside their own borders. And that's why the world can be in debt without there being one single collector at the top. But we're not done. Because there's a second twist. 2. The real system is built on safe collateral, not morality. In everyday life, a loan is judged like a character test. Did you borrow too much? Were you responsible? In global finance, debt is judged differently. Can it function as collateral? Modern markets don't just invest in government bonds. They use them as the dependable object everyone accepts when they don't fully trust each other. That's why US Treasuries are treated like the default plumbing of the financial system. Not because the US is perfect, but because treasuries are liquid, standardized, and widely accepted in financial transactions. So the key question isn't, will this ever go to zero? The key question is, will the system keep treating this as the safest chip on the table? 3. Who holds US debt, really? Let's ground this with the country people talk about most, the United States. Foreign holdings of U.S. Treasuries reached a record about $9.355 trillion as of November 2025. The U.S. Treasury's own major foreign holders data shows the same scale: Japan around $1.2 trillion in treasuries, with the UK also very large and China lower than in past eras. So yes, foreigners hold a lot. But compared to total U.S. federal debt above $38 trillion, that foreign slice is not the whole story. A huge portion is held domestically by retirement funds, banks, mutual funds, insurance companies, and the Federal Reserve System via various mechanisms. So the "America owes China" storyline is a shortcut that hides the real structure. America mostly owes the global financial ecosystem, of which Americans themselves are a major part. Debt payments, in many cases, circle back into the same society through portfolios. But the distribution of who benefits inside that society, that's where the tension begins. 4. How did we end up here? Start before central banks felt modern. Most people assume government debt is a modern invention, something born with stock tickers and bond traders. But the deeper story begins earlier, when governments learned a dangerous lesson. You can raise money in two ways. Take it immediately: taxes, tribute, seizures. Rent it from the future: borrowing. Some of the earliest large-scale, public debt experiments appeared in merchant republics where war was expensive and coin was limited. City-states like Venice created systems where wealthy citizens financed the state, often through forced or semi-forced loans that later behaved like tradable claims. That wasn't just finance. That was politics, turning military survival into a structured promise. Later, European powers refined the idea. A state that could borrow reliably could mobilize faster, fight longer, and outlast rivals. Over time, the ability to issue debt became a form of state power, not a sign of weakness. And eventually, government debt became something even bigger. Not merely a way to fund emergencies, but a permanent instrument the financial system depends on. 5. Why governments don't finish their debt. Here's the part politicians rarely say plainly. Governments typically don't treat debt like a personal car loan. They treat it like infrastructure. Bonds mature. New bonds get issued. Old ones get refinanced. The system doesn't need the stock of debt to vanish. It needs the payment schedule to stay believable. In other words, the goal is not zero. The goal is continuity. And that continuity does something powerful for markets. It manufactures a steady stream of assets that can be held by pensions, used by banks, and traded at scale. That's why a world with no government bonds wouldn't look like freedom. It would look like financial starvation, a shortage of the very instruments used to stabilize portfolios and secure lending. So the debt persists, not necessarily because leaders are reckless, but because the architecture of modern finance is built to absorb and rely on sovereign bonds. 6. Central banks, the quiet engine room. Now we reach the part that feels like magic until you see the wiring. When a central bank buys government bonds, it pays by creating reserves, new money inside the banking system. That means one institution's liability becomes another institution's asset, and the financial system expands. This is why people argue about whether money is backed by anything. In practice, much of modern money is backed by balance sheets, layers of claims, held by institutions that trust the system will keep functioning. And that brings us back to the original riddle. Who is owed? In a closed-loop world of balance sheets, the answer is everyone is simultaneously someone's debtor and someone else's creditor. It's less like a single pyramid and more like a dense network. A map of obligations where the direction of payment depends on who holds the assets. 7. When trust cracks, the creditors suddenly have names. Most days, this machine looks smooth. Until it doesn't. When confidence breaks, debt stops being an abstract number and becomes a negotiation, and sometimes, a punishment. We've seen this pattern repeatedly, but with different faces. In Greece, 2010, markets demanded higher yields, refinancing became a crisis, and rescue packages arrived with hard conditions that reshaped daily life. This is the one example kept broadly similar, per your rule. In other places, the story has looked different: currency pressure, reserve depletion, forced restructuring, political shocks, social unrest. The point isn't that debt is evil. The point is that debt is a contract, and contracts become brutal when one side loses bargaining power. In calm times, the creditor looks invisible. In crisis, the creditor becomes real. Institutions, funds, official lenders, and policy conditions that arrive with the money. 8. The uncomfortable truth, we owe ourselves, is only partially true. You'll often hear, "Don't worry. We owe it to ourselves." That can be true at the national level, especially where domestic institutions hold a large share of government bonds. But zoom in. Who inside the country owns the bonds? Who receives the interest? Because interest payments don't fall from the sky. They come from taxes, from inflation dynamics, from the way public budgets are structured. If bond ownership is concentrated, then the flow of interest is concentrated. So even if a nation owes itself, the experience is not equal. Some households are positioned as receivers, others as payers, directly or indirectly. That's how a debt-based system can coexist with rising inequality. Not because debt automatically creates inequality, but because ownership of the assets can be uneven. 9. So, who exactly is the world paying? Now we can answer the paradox clearly. The world isn't paying one mastermind. It's paying a web of holders. Pensions looking for stability. Banks needing collateral. Insurers matching long-term liabilities. Central banks managing currency and liquidity. Global investors balancing risk. And that's why debt keeps growing without a single endpoint. Because sovereign debt isn't just money owed. It's one of the main financial materials modern markets are built from. The real danger isn't that the world wakes up one day and pays it all off. The real danger is something simpler. A world where confidence fractures. Where refinancing becomes expensive. Where the safe asset stops feeling safe. Where the network begins to demand higher payment for belief. Because in the end, sovereign debt isn't merely numbers. It's a public promise traded as private property. And if that promise ever stops being trusted, the system doesn't gently reboot. It reshapes who gets to survive. If this changed how you see money, hit subscribe. On Empire of Money, we don't chase headlines. We trace the power underneath them. History leaves receipts. And we're here to read them.